Hello, everyone, and a very warm welcome to this week's Major Markets Update for Friday, December the 13th, 2024. It is a bit of a bad luck day, of course, Friday the 13th, but overall, the market didn't do too bad. And in this week's update, we're going to go over the fact that there are three types of market corrections. One is in price, the other one is in time, and the third one is through breadth. So that means that the market simply corrects under the hood while it keeps a bullish posture, sometimes just keeps on rising. And all it does is take care of very overbought conditions under the hood, and eventually it will flip around and market breadth will increase together with price. So I want to show you those items one by one. We'll start with the Dow Jones. The Dow Jones has clearly corrected in price. We now have 7 down days in a row. I don't really know when the last time was that the Dow dropped 7 down days in a row. If anybody knows, please let me know. I'm going to look it up when that was. Maybe I can find it. When was the last time for 7 consecutive days? But its long-term uptrend is still intact. Okay. Yes. Let's see here. So the S&P 5. No, never mind. The jury is still out there. I actually asked the ChatGPT and it said it was March 2022. I went back and that absolutely wasn't true. Then it told me it was somewhere 2015. Neither. 2018. Neither. So never ever take anything for granted. I don't know where that AI bot got its data from, but that is incorrect. You can look it up yourself. So with 7 down days in a row, and as I said yesterday, 6 down days in a row is quite uncommon. 7 is, of course, even more uncommon. 8 to 10 down days in a row, that is typical bear market behavior, and clearly we're not in a bear market. However, this index strongly suggests it is in its wave 4. I have zero confirmation that the tech sector or the S&P 500 is in their own wave 4. This also shows each and every index must always be treated by its own merit. We have not 7 days in a row for the tech sector. Instead, the tech closed at an all-time high today. It reached a new all-time high. Crazy, huh? However, we see here correction in price, 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 correction in price. Now, the other one is a correction in time. This is something you can see here pretty much in most of September where the market just went sideways. It's a sideways consolidation. Technically tends to happen in fourth waves, and then we move higher again. Okay? That is a correction in time. The other one are corrections in breadth. So under the hood, the market needs to get rid of its very overbought conditions, like we saw here in late 2023 going into early 2024. So as you can see here, market breadth declined. This is the summation index of the S&P 500. The summation index is based on the McClellan oscillator. Okay, the McClellan oscillator simply measures how many stocks are advancing, declining, or staying the same. And if that number is greater than 0, then the McClellan oscillator is, of course, positive. And if that number is less than 0, meaning more stocks are declining than advancing, the number is negative. I'll get back to this indicator in a moment, by the way, because it's getting very interesting from a buy signal perspective. So the summation index then adds today's McClellan oscillator to that of yesterday, etc. So you get a summation index. 2023, declining market breadth after being overbought, but you can see the market moved higher. 2024, declining market breadth, but the market moved higher. Again, 2024, we had declining market breadth, the market moved higher. Again, 2024, declining market breadth, market moved higher. Okay, so under the hood, the market simply takes care of these extreme overbought conditions, and you won't notice anything in between. This is like these big tech rallies. The mega cap stocks keep on rallying, and all the small cappies and mid cappies are kind of correcting. So that's why people that have individual portfolios based on individual stocks in the small mid cap often underperform. Whereas if you really index your portfolio, you simply track the market a little bit better. That's something entirely different, but you can see here, this is, of course, a market breadth correction. These are corrections under the hood, and then the market can continue to rally, take care of it, eventually get negative divergences, maybe not, depends, but again, it shows we've taken care of these very overbought conditions, and we can continue to rally. And that's something we might actually see once again develop, right? The S&P 500 has gone nowhere. It is down 0.6% for the week. So we have zero indication that that red wave 3 that we're tracking has stopped. We're starting to look for 6,060. And if that was broken to the upside, we would look for about 6,150. If that's going to get broken, we're going to look for higher prices. We cannot predict the future. We simply go by what are normal Fibonacci extensions for a given pattern. In this case, we believe we're in ending diagonal, then the first target is the 123.6. If that gets broken, 138.2. The market doesn't have to top for the ending diagonal at that level. It would be way too easy. Everybody would know it, right? So the Dow Jones is clearly corrected in price. Now, since the Dow Jones has not broken below the final invalidation level, which is the November 15 low, we have several options available to us. The first one is the ABC for this red wave 4. This is the preferred scenario, okay? That would confirm the red wave 4. We're going to bounce pretty soon from maybe slightly a little bit lower. I would say somewhere around 43,500, 43,750, very marginal. And then we're going to bounce higher to these support levels that are now resistance between 44,500 and about 44,800. And then we get the next leg lower for this red wave 4 completion. And then we're going to get red wave 5. Okay, so the Dow Jones is, in my humble opinion, much more likely in the red wave 4. The other indexes, not. They don't have to. It just shows you how complicated the market can be. By looking at one, you might get misguided on the other ones. So we always treat each and every index for by its own and for its own merit. So the next option is that we have this subdividing wave 3 on our hands. So we have an A, B, C. Okay, but then the C wave is not all of C, it's an A of C. And we're going to subdivide again. I think I've shared this with you before using, for example, a Pretzel Logics chart for the Dow Jones. Okay, and then as you can see, if we bottom a little bit lower, somewhere around 43,700, then a simple CSA in orange targets the upper end, which is equal to the CSA in gray. The CSA in gray is 1 degree higher than the CSA in orange. And also the green, of course, is 1 degree higher than the gray. The red is 1 degree higher than the green, etc. Okay. I want to point out we're getting quite oversold. No turn, right? No turn. So we can't front run anything. No turn, but getting quite oversold, which this whole year has led to very good risk reward from a swing trading perspective. Okay, but again, if you would buy here, right, you had still no good signal that it had bottomed. So you got to kind of wait for either positive divergence or when the RSI starts to shoot back up above 30. Those are quite good indications. If you'd bought here the first decline in October, you can see you had a little bit of downside risk and very good upside reward. The same here in August, right? You had very good downside risk or very little downside risk and very good upside reward. So we're getting there again, quite oversold. It's a condition, it's not a trade trigger, but if past performance is any guarantee for future results, then we might start to look for these higher prices quite soon and target, let's see what we're going to get if I put a number on it. If we're going to bottom out and we're going to put the number on it, 45,000 something there, 45,790. Okay, we can still easily target it. Okay, so then this is the length of A measured from the bottom of that one. It is, of course, wave B. As you can see, gets us right there. This is then the length of this orange wave right there. And if we go a little bit lower, as you can see here, we go a little bit lower to about 43,660, then we are pretty good. Okay, 43,000 B at 43,660. That would be fantastic. Okay, that would be fantastic if we get that, of course, right? And then we get the CSA wave 5 for 1, 2, 3, 4, 5. So this would then be counted as also a ending diagonal within a diagonal. I count it all as ABCs of a subdividing wave 5, but it's fine. You can count it 1, 2, 3, 4, 5. Yeah, super easy. Okay, so that's the second opinion and possibility out there. And this is also the problem if we don't break below key warning levels, right? If as long as we hold the November low, this is a option available to us because we have not confirmed that the top on December 5th was indeed the red wave 5. We cannot confirm it. It really looks that way, but we cannot confirm it. Okay, this is the longest decline, so most likely this trend has ended. That is all we know. And then, of course, the really most bearish one is that we have completed the bull market. Okay, this is a slightly different wave count. We've broken below the first warning level for this wave count. We're not even below the second one, let alone the third or the fourth one. Okay, so we definitely need a lot lower prices to confirm this wave count. And it shows you the wide variety of possibilities we get if we don't break below key price levels, which is the November 15 low, essentially, right? Then we start to see a lower low, which really increases the odds that, okay, now we're probably in a bear market. And that's, of course, extremely early. If you can call a bear market like a week after the bull market tops, you're out extremely early. Most people won't know what happened to them till we're pretty much at the bottom of the bear market. So this is extremely early. But it also points out, one, the difference in interpretation. How do you interpret the price chart? And two, if you don't break below key price levels, you can slap a lot of wave labels at it, and all of them are equally valid. However, we prefer at this stage the potential for a bounce and then lower. Why? The bounce is conservative, right? And we try to be conservative, whereas the ABC is quite aggressive. This one points higher from slightly lower. We're currently at 43,828. Now, if we drop to 43,000, not 3 years, that is quite a big number here, to 43,660-ish, right? And start to rally from there, then we can go to potentially 45,790. So that's a 2,000 point gain on a little bit over 40,000. So that's another 5% rally. Okay, that's a 5% rally, and here we're looking for about a 2% rally. So both are looking higher, and then the last one, yes, we can bounce, and this is maybe an impulse 1, 2, 3, 4, 5. Just merely want to point out the potential that's in the chart due to this price section that has not broken below key levels. So this is the least favorite option, okay? The most favorable from a conservative point of view is ABC, and then we can see again if we get the 4 yes or no. That's where we are at right now. So that brings me back to the McClellan oscillator for the S&P 500. Okay, and see here, I don't think it has updated just yet, so we're going to revisit it in a moment. Meanwhile, the AD line keeps declining, but as you can see here, the S&P 500 is still flat. So the S&P 500 is correcting more in time than in price. Okay, just as you saw here, correction in time, and then we move higher. Okay, so those are all valid options. S&P 500 is correcting in time, maybe by market breadth as well. Dow Jones is correcting in price, but in essence, all of these are still in long-term bullish uptrends. That brings me to the NASDAQ 100. And we're getting close to these target zones that we set forth for the C wave of the third wave. Not really there just yet. We've already extended well beyond what is normal for the third wave, which is this red wave target zone. Well, then we extend. That we don't know beforehand. Once this wave 3 was confirmed by breaking above the all-time high, we start to look at the normal extensions, the 138.2 to 123.6, potentially 161.8 for the third wave, okay? And we've broken it above it. Then you're going to look for the next higher level. Yes, there's plenty of negative divergences out there, but you can see the trend is 100% your friend, as it is 100% bullish. Again, the NASDAQ needs to drop below this A wave low, which is currently at about 19,300, to tell me that this red wave 4 is on the way. We're still missing a red wave 4. We're still missing a red wave 5. We have zero indication red wave 3 has stopped. Simple, all right? And even if we top for red wave 3, we still need a red wave 5. Same for the NASDAQ 100. And now that we've reached the 138.2%, not yet closed above it, we are going to adjust the wave count into a slightly more bullish one. Why? Because we've broken above this orange target zone, okay? So broken above the orange target zone starts to suggest that this is a impulse pattern, 1, 2, 1, 2. It's ugly. And then 1, 2, 3, 4, 3, 4, and then subdividing wave 5 higher, which can go to 22,447. Now you can say, I sold everything, right? When we reached 123.6. Well, that you should not do. As I said before, take partial profits, raise your stops. Never said throw everything and the kitchen sink out the window. That's, of course, not what we're aiming for. We want to be conservative, and we raise our stop levels. All right, now the stop level is at yesterday's low. It used to be at Wednesday's low. So slowly but surely, we're raising these warning levels. The gray warning level has been raised from what now is the orange warning level. Okay, why? If this is indeed a impulse where we are in gray wave 3, we don't want to see it go below the gray A1. Okay, then this wave here is indeed going to be an impulse, and potentially the wave here is going to be an impulse as well. And we can still target 22,447. There's zero reason to tell us that it's not the case. Why? Because we're in a bullish uptrend and we haven't broken below any warning level. Hasn't done it at all. Other than this week, I think it broke below the first warning level, and that's about it. Okay, and first warning level doesn't mean too much. It's just like, no, okay, maybe start paying a little bit of attention if we see follow through, and we have not gotten the follow through. So this one is slightly different than the Dow Jones. This is where the NASDAQ 100 and NASDAQ are, and the Dow Jones is here. What a bifurcated market. This has been quite often the case, so that's why we always count every index differently. So now the Dow Jones can rally and technology can drop. Very possible, right? There's no reason why not to. But we're in a 100% bullish uptrend. All market tops occur in 100% bullish uptrends. But for now, that is what it is. And that's what we stick with. The same for the S&P 500. It reached its target zones. All right, it reached the gray target zone for the C wave. It's in the green target zone for the C wave of 1 degree higher. It's in the red target zone of the third wave of 1 degree higher as well. But it hasn't even broken below Tuesday's low. Okay, so it's broken below the first warning level, but we've not been able to break below the second warning level. And then that's really all there is to it, other than but a sideways mess. Okay, so above last Friday's high, and we can target 6150. Above 6150, and we can target 6175. And that's as much leeway as I want to give this C wave, because then we would otherwise go to 6278. It's very possible, okay? We're still in this third wave. We have zero indication that it has topped, okay? And I don't think I've ever recommended anybody to short this market at all. I cannot recommend it. I don't do any trade recommendations in the first place. I just tell you pretty much where we can expect a top and a bottom. And if those tops and bottoms don't occur where they have to, we're going to go to the next lower or higher levels, right? Whatever we're aiming for. Currently, we're looking for a top in this wave 3. We haven't seen it yet. Things don't look too good, you know, with negative divergences, sell signals, but price is the final arbiter. Everything else is secondary at best. And then we go to the semiconductors. This is the headache indicator of index. It's the one that's the hardest to track because of its excruciatingly overlapping price action. So this can still be a wave 4 if it wants to of this expanding ending diagonal, but we're moving now to our alternative wave count that we are in this B/2 wave. We might have completed this expanding ending diagonal A1. All right, it's still a question mark. They're quite uncommon. They're very rare. It is a little bit of exotic interpretation, but it works really well. It does. So now we'll see how this is going to develop, and we're going to look now for 5350 plus or minus 50. If we break above this red B/2, then we're going to transfer that one over to where we currently are. And this whole rally since August is becoming protracted and more bifurcated than I would wish it would be. This is a ugly index for now, and it remains my least favorite. IWM, also here, we've had a serious decline. Boy, it's been mostly down for a month now. But again, we've not broken below the key November 15 level, although we are right at the third warning level. So this is our preferred wave count, A, B, C, okay, that we are in this red wave 4. So most likely the IWM or the Russell 2000 and the Dow Jones are in their red wave 4s, okay? The other indexes may still very well be in their red wave 3s. Let's have a look at bullish percent index. We're starting to see negative divergences develop for the NASDAQ. All right, it's not necessary instantly that we have to throw everything out of the window. We've had it here before in the early parts of 2024, as you can see, and the market still rallied significantly higher. Okay, it is a first warning signal under the hood for the NASDAQ. How about the PMO buy all sell all indicator? It remains on a sell. Okay, so also here you can see since the sell signal, the market has gone slightly down, mostly sideways. Okay, this is not a steep correction. This is not something we saw like in the July timeframe. This is a sloppy sideways price action, and this one might now soon bottom out at 0. So I don't have data for it yet. I'll share it hopefully with you when I send out this email. That'd be great. It's going to take then a little bit longer for that email to come out, but then you can really see where we're going to bottom. If we're going to bottom at 0, it starts to increase the odds that we're going to get a very good buy signal again, and then we might really have to look for those much higher prices in the 6200s. Okay, so let's have a look once again at the McClellan oscillator. Hopefully it has updated by now. And boy, we're at minus 71. Okay, this is quite steep oversold. So let's have a look at how has the index performed this year when we had such low readings. So we've had pretty much, I'm going to show you this one here as well. This one here, and those two there. Okay, so we had, so we're now at this one. I'm going to do that one red because there were two false readings, and you'll see that in a moment. So we're very oversold. The McClellan oscillator is getting quite oversold. All right, we can zoom out a bit more. And even here, historically, you can see we're getting quite oversold. Definitely in the hundreds is a very good sign. We're getting very close to a bottom. But most of the time, if you go further back in time, unless you're like at COVID lows or 2022 type lows, which we're definitely not in yet, you can see that these type of low readings tend to happen often at good market lows. Okay, that's really the message. So now we're going to try to compare apples to apples, and we're going to look at this year. All right, this year only, and let's see what we're going to get. So there we are, beginning of this year, below 60, and this one went minus 80, etc. You see, every time we go below minus 60, we're getting close to tradable lows. The extreme one was, of course, the April correction. That one went below minus 100, and that's a really buy, baby, buy signal. Okay, so this is between minus 60 and minus 80. I call that a buy. Between minus 80 and minus 110 is buy, baby. And then if we go below minus 110 is buy, baby, buy. You really got to remind your baby to buy. Okay, and so we have 1, 2, 3, 4, 5, 6, 7, 8, 9, and currently 10 signals. or 10 occurrences below minus 60. We had 1, 2, 3, 4, 5, 6, 7 that were really good signals. Of course, this one went well below it, right? Well below it. And we had 2 fake ones. This is the initial one here in early April, as you can see. And we had here one in late October. So those did not give good signals. So pretty much 7 out of 9 were really good signals. Okay. So this is then the false one. And this is also a false one, followed by a good one. Here we had slightly sideways up, and then we went down, and still good risk reward. Here, definitely a little bit up, definitely a lot more down, and then very good risk reward. Okay, so yes, we have 7 instances where every single time we got very close to a market bottom. Okay, I've included this one here, which got very close, I believe minus 58. Here exactly minus 60. And then this one here, of course, as well. This one's not correct. And then here. Okay, so you can really see also here, for example, you have all this negative divergence going on, but the market keeps moving higher. Negative divergence is not often a very good signal for a market top. A bottom is often much more immediate, it's instantaneous. So that really shows us that most of the time we're going to get a good signal if we are below minus 60. And especially, of course, below minus 80 is a very good sign. And here you can also see, for example, right, you have this total market correction, and what is priced on, it's just gone higher and higher. Yeah, we have some down and up sequences, but from here, of course, you have plenty of room to go to the upside again, right? That's what I mean with a market breadth correction. Bottom line is we are now in the 10th occurrence this year where the McClellan oscillator is below minus 60 and very close to minus 80. And that's very rare, honestly, to get that low, especially this year. And from there, good buy signals tend to occur. So that means if we would look at the summation index, that's the PMO. Let's see if I can find the summation index. Where did I put it? Yes, here it is. The summation index is now, of course, getting also oversold once again. Interesting. So either we're going to completely crater and crash, right? With the McClellan oscillator well into the minus hundreds, or this is soon going to resurrect itself. Okay. And you can see here that the market has technically moved higher while breadth has been moving lower. Interesting, huh? So definitely do not use market breadth only for your trade decisions. In fact, only use it as a qualification, so to say. So there we are, and then the PMO will send you once it has updated. How we're doing on sentiment? Yeah, sentiment is not our favorite indicator. A little bit overcooked for money manager exposures, but nothing too crazy. We're not even leveraged. And even if you're leveraged, well, the meaning above 100%, the market can still move higher by a lot. It's more helpful to look at extreme negative sentiment readings. Extreme negative sentiment readings are much more accurate than extreme bullish readings, because the market can remain bullish for much longer, but it can't remain fearful for that long. CNN Fear and Greed Index is at neutral, so there's room for improvement on that one. It's been neutral for a week pretty much, so not too bad. How we're doing AAII? Well, this is also inconclusive. Mom and pops are on average. That's not really too bullish or too bearish. We're average bearishness 31%, average neutral. We need to be like 2 standard deviations away from the average to really tell us that sentiment is too extreme, and we're definitely not there yet. And then, of course, seasonality. That's our last reliable indicator. It's just an average of, in this case, 127 years of data. And every data point is just added for each day, and you make an average of it. So it would be nice actually to see the standard deviation. However, this is for the Dow Jones, and the Dow Jones was on average supposed to top somewhere around December 6 to December 9, right? You can see there. And that's kind of what we got, right? We topped here, I believe, December 5, and then it would decline according to average seasonality. It will decline into somewhere between December 12 and December 16. So that's current time frame. And from there, as you can see, the good end of year Santa Claus rally should materialize, assuming this average seasonality pattern holds up. So far, so good. Not too bad, right? We would rally into this. And we've done that from November into early December. And we've definitely done that. I'm going to move those maps. So, right, we've done that. As you can see here, we should have bottomed out somewhere, ideally November 20th. Well, we bottomed out November 15th. Not too bad. And then rally into December 7, 8, 9. And that's exactly what we did for the Dow Jones, right? And then decline. And that's what we're currently doing. Quite a steep decline. Again, these are averages in percentages. We're just looking at the direction. The extent of that direction, that's not what matters. And then we should bottom out somewhere around 12, 13, 14, 15, 16, right? So 12, 13, 14, 15, 16, all depends, of course, when the weekend is. And that's where we're getting very close to. And then a big rally starts. Okay, so that matches with our wave count, ABC. So this ABC rally wouldn't match too much, of course, with the rally. But again, this can last for 2 weeks, right? An A, a B, and a C for B. Alternatively, we're going to do this one. Okay, so seasonality starts to support higher prices pretty soon as well. We might see turnaround Tuesday, for example. Okay, I know the Federal Reserve is due on Wednesday. So then indeed, we might see a low. Let's see when that Wednesday is. Of course, that would be somewhere around 17, 18, right? Then we might see a good rally on the 18th. And based on seasonality, that's exactly kind of where we're going to bottom then, right? Somewhere around there. So if that's all good, then that's all good. We go by price levels. This one is something for the back burner. We keep it in the back of our heads and mind and think about it. And if it's transpiring, then it's great. Then we have a pretty decent roadmap ahead of us. It's worked reasonably well since November, right? We should have seen a low mid-November-ish, and that's what we got. We should see a rally into early December-ish. That's what we got. We should see a decline into mid-December-ish, and that's what we've got so far. So far, so good. So then it's really not too much of a stretch to think we're either going to go to about 55,790, or we're going to first go to about 44,800, drop one more time for this wave 4, not much too low below this A wave, doesn't have to be CSA. This trend line is, of course, very important. But once again, you can see, right, still bullish trend despite 7 down days. But the Dow Jones has corrected in price, and it has corrected quite severely from where often good risk reward is starting to transpire for those that desire to swing trade. Also, market breadth, as I showed you, is getting quite oversold on a historical basis as well on this annual basis with readings in the minus 70s, not happening too often, as you can see, right? Most readings, as you can see, are right there in that region somewhere between minus 30 and plus 30. This is where most readings are. So we're getting quite oversold, but no sign of a reversal yet. And remember, if market breadth turns around, it could definitely carry the indexes much higher than what we originally anticipated. But that's where we go by, the anticipation. Anticipate, monitor, adjust. That's all we can do. We anticipated these highs, 60-60, above 60-60. We're going to look for about 61.50, above 61.50, 61.75. Above that, we're going to go to the 7200s, right? 7200s. Above that, we can even go to 6300. That's entirely possible. As long as we hold above these warning levels, there's no reason to look lower. Yes, there are enough scribbles in place, all that good stuff, but we can always extend. Please keep that in mind. And if you say, I sold some in these target zones, well, you can always add, get the next bus. They're bull traders and old traders, and kudos to you. You had a winning trade. Definitely, please do not short this market, especially not tech or the S&P 500. At this stage, I don't see a reason at all. If you did want to short, then you should have followed our ETF Trade Alerts service, who did a successful inverse ETF for the short term on the Dow Jones and is now fully profitable. Tiny position, only a quarter of what what one would normally do. Let's say it normally would do a $10,000 position or 25,000, whatever, or 1,000. Then you would only expose to 2,500 or $250. Very tiny. There's very little risk. That's what we do. We manage the risk, and that trade has become profitable, and looks like it's starting to wrap itself up by raising stops so that we lock in the remaining profits. And with that, I'd like to say goodbye. Thank you so much for listening. Thank you so much for being a valued premium member. Take care, trade safe, have a wonderful weekend, and I'll see you all next week.